Welcome to Ask gHawk Accounting, where I answer questions from small business owners about tax, accounting, and how to run a profitable business. My name is Lenah Oduor. I'm a chartered accountant, a business coach, and the founder of gHawk Accounting. Our mission is to empower small business owners to run smarter businesses, unlocking more profit, more time, and the freedom to enjoy it. The answers given in this recording are general, and you should seek professional advice for your specific circumstances. Today's question is from a director of a limited company, and here is a question. My house in Banbury is being rented out from 10th of January. So can Lenah please advise what records and information you will need for this, and what expenses I can claim, if any, for the work involved in renting it out? For context, the person asking the question is a long-standing client, a director of a limited company who has recently acquired a rental property. The property is owned personally, not through the company, and this is an additional source of income. There is an expectation that the tax payable will be higher than the previous years if this is not managed proactively. So let us look at some background information before answering the question. So why become a landlord? Becoming a landlord is a smart move which comes with many advantages. First, it provides a steady income stream because rental income is normally collected monthly. Second is the capital growth. Property values generally increase over time, offering a long-term strategy for growing your wealth. Expenses are tax deductible, which means landlord can claim various expenses to reduce the taxable profit. Portfolio diversification is another one. I'm sure you've heard the term, don't put all your eggs in one basket. Investing in property helps to spread financial risk. Inflation protection. Rental income typically rises with inflation. And finally, it is a good pension supplement. Rental property can serve as an additional retirement income stream because it tends to be passive income, which you can still continue to receive without putting in too much work. You will typically come across two types of expenditure. There's capital expenditure and revenue expenditure. It is important to understand the difference between capital expenditure and revenue expenditure because it helps you know what can be claimed when. Capital expenditure is costs incurred to improve or extend the property beyond its original condition. These are not deductible against rental profits but may be deducted when selling the property. Revenue expenditure, on the other hand, are costs associated with maintaining and managing the property. These are deductible against rental income to reduce taxable profit. Examples of capital expenditure are things like property extensions, loft conversions, structural changes, first-time installations of improvements like central heating, insulation, or double glazing, replacing an old kitchen with a newer, higher spec one, adding additional bathrooms or bedrooms, complete rewiring that includes new fixtures or fittings, or initial property renovations after purchase. These are capital expenditure costs because they improve quality and the value of the property beyond its original condition, and these are not deductible against rental profits, but can be deducted when selling the property. Examples of revenue expenditure is things like routine repairs and maintenance, replacing broken windows, repairing leaking roofs, decorating between tenancies, landlord insurance, letting agent and property management fees, legal and professional fees, except those for the property purchase, utility bills, council tax, if these are included in the rental contract, advertising, marketing, accountancy fees, service charges, and ground rent. These are examples of revenue expenditure, and these can be deducted against rental incomes to reduce taxable profits. Given the advantages of being a landlord, it would be a surprise if the tax system did not apply to them in more than one way. Landlords must report rental income and expenses to HMRC annually. A property business comes under the tax system in three ways. First is income tax. Rental profits are added to other incomes and taxed at the applicable rates. Revenue expenditure, as we've said, is deductible against rental income to arrive at the taxable profit. Capital gains tax is payable when selling the property for a profit. Capital expenditure is deductible when calculating capital gains tax, which will reduce the taxable gain on the sale. And stamp duty land tax is payable when purchasing a rental property. With that background in mind, let us go back to the original question. My house in Banbury is being rented out from the 10th of January, so can Lenah advise what records and information you will need for this and what expenses I can claim, if any, for the work involved in renting it out? So far, we have covered a lot of ground towards answering this question. We know that the applicable tax here is income tax for an individual. We also know that under the income tax, we cannot claim capital expenditure. So what we would be looking for in terms of documents is a list of revenue expenditure. And so the information required is as follows. The records we as your accountants will require to prepare property accounts for your self-assessment tax return are as follows. A record of rental income received, including any rent-free periods or discount. Expenses, a list of property expenses, e.g. management agent fee, maintenance, repairs, utilities, insurance, mileage, travel to mileage, and other operational costs incurred wholly and for the purpose of the business. Mortgage statements showing the interest paid, lender information, interest rates, and the terms of the loan. We also require any letters from HMRC if you've received any, and any other information you deem necessary. The reason it's important to provide additional information to your accountant is that you may miss claiming an expense which could have reduced your tax. It's better to provide more information and then get guidance on what is allowable or not. Thank you for watching this episode of Ask gHawk Accounting. Today's question was about what expenses a landlord can claim on their rental property and what document an accountant requires to prepare the self-assessment tax return for a landlord. We have covered the benefits of being a landlord, the difference between capital and revenue expenditure, examples of capital and revenue expenditure, how rental property is taxed, and the records required to prepare the property accounts. I trust you have found that useful. If you have any other questions about tax, accounting, or how to run a profitable business, send them via our website, which is ghawkaccounting.co.uk/contact. The link is provided somewhere below this video. If you have enjoyed this video, please like, share, and subscribe so you can get notified of our next video. My name is Lenah Oduor, wishing you every success in your business. Thank you for watching.